All the articles and opinions about Silicon Valley Bank made me very, very curious. I had a lot of questions which needed to be answered for me to understand more about the SVB debacle and simplify for you, such as what is SVB? What went wrong with SVB? What trade led to the fall of SVB? Welcome to Simplified with Ashish. I'm Ashish Soni. Every week I simplify the biggest stories in markets, finance and business world. So if you're interested in these topics, consider subscribing to get the simplest explanations for the most complex topics. We all have read that SVB has shut, but very quickly, let's understand why does any business shut. For that, let's hear a story. Let's suppose you have purchased a computer on loan. You use this computer to teach online and earn money. The EMI of the loan is getting deducted from your personal bank account. But the money for EMI comes from your father's bank account. Now suddenly after 3 months, your father stops sending you money for EMI. And there are 9 more EMIs left. What will you do? You will try to find the money from somewhere else, right? And if you are not able to, then bank gets to keep the computer and your income becomes zero. Hence, any business shuts because it becomes unable to generate revenue from its assets. This is exactly what has happened with SVB as well. SVB is a commercial bank whose revenue sources are interest income earned and non-interest income, which are generally service fees. Interest income is 72% of the revenue, hence we'll focus more on that first. This comprises of interest earned on loans, fixed income investments in their available for sale and held to maturity security portfolio, and cash equivalents. All these interest income sources are completely dependent on deposits from companies. Remember father providing money from the story? The deposits are largely obtained from companies in technology, life sciences, healthcare sector, and startups from private equity and venture capital industry, such as Pinterest, Shopify, Roku, Rocket Lab, and even Indian startups such as Zenoti, Resolve.ai, etc. etc. So much that, according to information sourced from their website, 44% of US venture-backed tech and healthcare companies that went public last year are represented by them. During the funding boom of 2021, SVB amassed large deposits, close to about $189 billion, which later peaked to a massive $198 billion. Now let's park this thought for here and see what went wrong. Now the entire debacle started when SVB said they suffered a loss while selling all of their AFS portfolio. To understand this line, you need to understand how they earned income from AFS or available for sale securities portfolio. And moreover, what exactly is AFS? AFS is used by the company to park the excess deposits into interest earning instruments. As you can see, SVB parked their excess deposits from companies, father providing money, in several AFS instruments such as US Treasury securities, US agency debentures, and residential MBS, mortgage-backed securities. It bought huge amounts of bonds with the parked money of the startups. In this process, however, it underestimated the risk of rising interest rates associated with it. Now, what is that risk, by the way? According to US SEC's document, there's a risk of fixed rate bond prices falling as interest rates go up and vice versa. Think of it like a seesaw. If interest rates goes up, bond prices fall, and if interest rates go down, bond prices rise. In the past 2-3 years, the 10-year treasury rate moved from a low of 0.6% to a high of 3.93% in March 2023, far above of 1.79% yield that the SVB portfolios was yielding. As the interest rates kept rising, it caused the market for IPO to shut for many startups and made private fundraising more costly. Higher interest rates can make investors more cautious about investing in startups because they may view them as riskier investments relative to other investment opportunities present in the market. Few SVB clients or startups started pulling money out. Read father stopped giving money to meet their liquidity needs as they could not raise capital in such an environment. This led to SVB looking for ways to meet its customers' withdrawal. For this, on Wednesday, SVB announced it sold $21 billion worth of bond assets at a loss of about $1.8 billion. Hence began the company's downward spiral. It also surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheet amid interest rate rising and customer withdrawals. Its shares dropped down 60% as investors fretted that the deposit withdrawals might push it to raise even more capital. And this is exactly what happened next. Because of unthoughtful decision of parking their hard-earned money in low-yielding bonds, every investor in Silicon Valley such as Peter Thiel, Y Combinator, Coatue Management, etc. started telling their portfolio companies to take money out of the SVB bank, leading to further withdrawal and more pressure to raise funds from the market. Hari Pragdish, the lead volunteer from SaaS Insider, a community of SaaS startups in India and the US, told Economic Times that he has been helping about 30 companies in this space since Friday morning with transferring funds to HSBC from SVB. He says, "I was just talking to one more investor. He has advised all, if you are in the US, just walk into any bank, open an account and move at least 6 months of your operational capital to the new bank." Other SaaS companies with Indian origin founders too have taken heed of advisories from investors and have started pulling out their funds from the bank, as FDIC, Federal Deposit Insurance Corporation, will only help recover $250,000 from bank accounts if SVB were to face insolvency. And finally, it happened. The withdrawals initiated by depositors and investors amounted to $42 billion on Thursday alone, according to the regulator. Despite being in sound financial condition prior to Thursday, the run caused the bank to be incapable of paying its obligations as they come due. It scrambled on Friday to find alternate funding, including through a sale of the company, meaning they went down the path to become almost completely unable to generate any revenue as their deposits were vanishing rapidly and they were on the path to become zero. And hence, finally they shut. By late Friday morning, the FDIC, Federal Deposit Insurance Corporation, had closed Silicon Valley Bank and taken control of its deposits, making it the largest US bank failure since the global financial crisis in 2008. According to your New York Times article, FDIC created a new bank, the National Bank of Santa Clara, to hold the deposits and other assets of the failed one. The regulator said that the new entity would be operating by Monday and that checks issued by the old bank would continue to clear. While customers with deposits of up to $250,000, the maximum covered by FDIC insurance, will be made whole, there is no guarantee that depositors with larger amounts in their accounts will get all of their money back. The article also mentioned that when the California bank IndyMac failed in July 2008, like Silicon Valley Bank, it did not have an immediate buyer. The FDIC held IndyMac in receivership until March 2009, and large depositors eventually only received 50% of their uninsured funds back. So exactly what trait led to the fall of SVB? I believe negligence and fear both were equally responsible for the fall of SVB. Negligence from SVB led it to keep the capital of startups in longer-term treasury bonds and not paying attention to the risk of rising interest rates. This led them to take harsh measures such as selling AFS securities and raising more capital to meet the drawdown requirements. Next is fear from the startups. After SVB identified its mistakes, they tried to rectify it, but the fear had already spread among the tight-knit investor and startup community, leading to companies withdrawing their money from SVB accounts extremely fast. After this, SVB did not stand a chance as it suffered a run, and therefore they shut and FDIC took over. Thank you so much for watching this episode. I'll see you guys in the next one.